Okay, this is lesson objective 5, and in this objective we're going to be valuing the accounts receivable. So companies classify receivables intended to be collected within a year or the operating cycle, whichever is longer, as current. All other receivables are long-term. Many companies value and report uncollectibles at net realizable value, which is the net amount they expect to receive in cash. Companies record credit losses as debits to allowance for debits to bad debt expense. There are two methods used in accounting for uncollectibles. The direct write-off method. With the direct write-off method, so when a company determines a particular account to be uncollectible, it charges a loss to bad debt expense. An example would be right over here, we have bad debt expense and accounts receivable. So direct write-off method records facts, not estimates. And the negatives are really that it fails to record revenues in the same period as the associated expenses. Nor does it result in receivables being stated at net realizable value on the statement of financial position. So this will contrast from the allowance method, which we'll go over next. Using the direct write-off method is not considered appropriate except when the amount uncollectible is I guess what they mean is like factual, when the amount of the uncollectible it's known. Basically, the direct write-off method is facts. You have to know it. In addition, so the direct write-off method doesn't involve estimates, and as a result, the amounts are immaterial. So the allowance method is going to have a material amounts, and it's going to be at a much larger value, and you have to use estimations with bases to get that allowance account. For this, you don't have an allowance account. You directly offset accounts receivable. The allowance method of accounting for bad debts involves estimating uncollectible accounts the end of each period or cycle. So this is more definitive in time period. This ensures that companies state receivables on their balance sheet at their net realizable value. And the net realizable value is the net amount the company expects to receive in cash. So this is more, in this example, we know the actual time period, you know exactly when. So as a result, if we know the exact time period, then we can estimate the revenues. If we know the exact time period, then we'll be able to offset expenses at a given point in time. So we'll know the exact value at a given point in time. It's not really so much as an estimate. So collectibility of receivables is a loss contingency. The allowance method is appropriate in situations where it is probable that the asset has been impaired and that the amount of the loss can be reasonably estimated. Blank are involved, however, companies can predict the estimations are involved. However, companies can predict the estimated values or uncollected receivables from past numbers, from past experiences, present value, present market conditions, and analysis of outstanding balances. Blank requires the allowance method for financial reporting purposes. I mean, basically, material, whenever you have like a material uncollectible, whenever you have an accounts receivable that is immaterial. Whenever you have an accounts receivable that's not material, when it is material, you use this method. And it is required by FASB. It is required by FASB. So whenever the uncollectibles or bad debts are material amounts. Companies estimate the allowance for doubtful accounts or the uncollectible accounts receivable. Company's debit estimated. And obviously you match revenues and expenses. Company's debit the uncollectibles to bad debt expense and credit to allowance for doubtful accounts, an adjusting entry at the end of each period. When companies write off a specific accounts, they actually debit the allowance account and credit the accounts receivable. So it's really interesting in that we put everything in a bucket and allowance for doubtful accounts. It's kind of a bucketed entry. And then when you go to specific accounts, you can write them off to the specific account that they are associated with. To illustrate the accounts, the allowance method assumed that Brown Furniture has credit sales of $1.8 million in 2012. Of this amount, $150,000 remains uncollected until December 31st. The credit manager estimates that 10,000 of these sales will be uncollectible. So it would be allowance for doubtful accounts and then accounts. No, I'm sorry. You're just starting out. So you're just starting out in the succession of entries. So it would be bad debt expense and allowance for doubtful accounts. Allowance for doubtful account shows the amount, the estimated amount accounts receivable, shows the amount of receivables, or it could be claims on customers, would make more sense. So contingencies are claims on customers. And again, that goes back to like non-trade receivables, so they're connected. A company is using allowance for a contra asset account and allowance for doubtful accounts instead of a direct credit to accounts receivable. They don't close account allowance for doubtful accounts at the end of the year. Recording the write-off of an uncollectible. When companies have exhausted all means of collecting past due accounts and collection appears impossible, the company should write off the accounts. So we booked it, now we have to write it off. So we do an allowance for doubtful accounts, and then we do an accounts receivable. And that can be a specific account now, because we're taking the allowance and we're putting it into a specific account. Now recovery of an uncollectible account, well, now we're going to take, now let's say that we're in error and in reality we are able to collect the amount of receivable. So we can go ahead and debit accounts receivable and then credit allowance for doubtful accounts, reestablishing the accounts receivable, and then we can have a cash for the debit and the credit of accounts receivable to then designate that we're receiving the cash. Base is used for the allowance method. Companies must estimate the amount of the amount of uncollectibles when they use the allowance method, or the percentage of uncollectibles or receivables. Two bases are used to determine this method: percentage of sales and percentage of receivables. Percentage So percentage of sale basis results in a better matching of revenues and expenses on the income statement point of view. Management estimates the percentage of credit sales with uncollectibles. You have like a bad debt expense in allowance accounts. And the percentage of sales achieves a proper matching of cost and revenues. This is frequently referred to as the income statement approach. Percentage of receivables provides a better estimate of net realizable value. Balance sheet approach. A company can estimate the accounts receivable that will become uncollectible without identifying the specific account. Can estimate the amount of accounts receivable that will be uncollectible. Again, net realizable value is a key concept. Provides a receivable with net realizable value. Companies may apply this method using one So you can use an aging schedule to do this, or you can use some type of a percentage estimates, or more commonly referred to as a composite rates. And that is about it for this section. So it's really just understanding both methodologies, the allowance method as well as the direct method. And for the allowance method, more specifically, understanding how to estimate the allowance accounts, and doing so with the sales method or the accounts receivable method, and understanding that it presents differently on the financial statements, being that one is more a better match of sales and revenues again, and the other is going to be more of a better match of portraying the accounts receivable at the net realizable value. And the direct write-off method isn't really a great representation of a certain period of time. So it's not a great, what I was trying to say before is that the period of time matters in matching the revenue and expenses. So if you know the period of time, you know what to match specifically, what revenue goes with what expense. If you're going off of a specific period of time, the direct write-off is just really looking at facts and circumstances, just directly writing off the accounts, and just directly changing the balance without really going back to where that receivable came from or when it came from. So it could be a lot farther back because they've been doing this method consistently throughout their annotating and book process. So they're not really identifying specific accounts.